Silver at $91, gold at $5,050, $6 trillion recovered in just 48 hours. Millions of buyers in China were literally locked out, unable to access physical gold at the exact moment they wanted it most. That alone should tell you this move was not normal, and what's happening right now is far bigger than a simple market rebound. In the last 2 days, precious metals staged one of the fastest recoveries we've seen in years. Gold is up more than 15% from the lows. Silver is up over 25%, adding another trillion. $6 trillion returned to metals while most people were still trying to understand what just happened. That kind of recovery does not come from optimism. It comes from positioning, forced liquidation ending. Before we go any further, take a second to like this video and subscribe to the channel. It really helps more people find analysis like this, and it keeps you connected to clear, fact-based breakdowns without hype. This is Past in Profit, where the goal is to help you understand the system, not chase noise. Now here's the key point most people are missing. This is not about price, it's about access. Price is what you see on a screen. Access is whether you can actually buy the asset when you want to. And right now, access is becoming the real story. In China, as gold prices dipped during the sell-off, retail demand surged so aggressively that multiple bank apps struggled or failed to handle the volume. People rushed in to buy physical gold products distributed through banks, and the system simply couldn't keep up. Accounts locked, apps crashing, delays everywhere. Imagine seeing the dip, having the cash ready, and being unable to buy because the system can't process the demand. That is not a technical glitch. That is a stress signal. This is exactly how it always starts. Reality says something very different. They want something tangible. And when enough people try to access the same limited pool at the same time, the cracks appear. At the same time this was happening in China, silver was quietly vanishing from vaults. In a single day, nearly 6% of reported silver inventory was removed. Millions of ounces gone, not traded. That's physical metal leaving the system while the paper price is rebounding. This matters more than any chart pattern, because when price rises and inventories fall at the same time, it tells you demand is real and supply is tight. Paper markets can talk all day. Vaults tell the truth. Right now, silver is trading around $91 in Western spot markets. In Shanghai, prices are higher. Premiums remain elevated. Physical metal is still priced above paper, even after a massive recovery. That tells you the shortage did not disappear during the crash. It intensified. During the violent sell-off, many assumed retail investors were dumping silver in panic. But the data tells a very different story. A much higher percentage of futures contracts than normal demanded physical delivery. In a market where only 1 to 3% usually take delivery, this time far more did. That means the crash was used as an opportunity to accumulate physical silver, not abandon it. Let that sink in. Paper prices were pushed down, and instead of everyone running away, real buyers stepped in and said, "Deliver the metal." That is not how weak markets behave. Now add the geopolitical layer. In the United States, silver has officially been elevated to critical mineral status. Not as a precious metal, but as a strategic resource essential for technology, energy, defense, and national security. At the same time, the government launched a multi-billion-dollar strategic stockpile initiative aimed at securing critical materials before shortages become severe. Governments do not do this when supply is abundant. They do it when they see risk ahead. They do it when they want to secure access before prices reflect reality. At the same moment, over 50 nations are meeting to coordinate supply chains and reduce dependence on single sources. This is not coincidence. This is preparation. When nations start treating metals like oil, you should pay attention. Now look back at what just happened in the market. A sharp sell-off across assets. Weak hands flushed out. Then a violent recovery as soon as selling pressure stopped. $6 trillion back in 48 hours. Open interest collapsing. Speculators gone. Only banks covering shorts and long-term buyers left. That combination is rare. This doesn't mean the path forward will be smooth. There are real risks. Japan's bond auctions are showing stress. Geopolitical tensions remain elevated. Any shock can trigger another wave of selling. But volatility does not erase fundamentals. In fact, it often reveals them. While paper markets swing violently, the physical market is tightening. Vaults are draining. Premiums persist. Access is becoming harder, not easier. And demand is coming from both individuals and governments at the same time. This is why focusing only on price can be misleading. Price can be pushed. If you can't get delivery, the quoted price doesn't matter. Gold reclaiming 5,050, silver holding above 90. These are not just numbers. They represent confidence returning faster than most expected, while the underlying supply situation is more strained than before the crash. There's another subtle signal here. When measured against gold, other assets are quietly losing ground. Volatility in paper assets has increased, while tangible assets are being quietly accumulated. This is what capital rotation looks like before it becomes obvious. So where does that leave us right now? $6 trillion. Recovered in 48 hours. China facing access issues during peak demand, silver vaults draining at an accelerated pace, governments classifying silver as critical and launching stockpiles, open interest flushed, physical delivery demanded during the crash. These are not normal conditions. This is not a routine bounce. This is a system under stress, revealing where real value is being quietly stored. The unresolved question is simple but powerful. Does the recovery continue as physical shortages tighten and governments compete for supply? Or does bond market stress and geopolitical risk trigger one more wave of forced selling before the final breakout? Both scenarios are possible, and that's why understanding the mechanics matters more than predicting the next candle. If you're watching this, you're already ahead of most people, because you're looking beyond headlines and screen prices. That's what we focus on here at Past and Profit. Logic over hype, structure over emotion. Leave a comment and tell me what you think happens next. Does silver push decisively higher from here, or do we get one more shakeout? Share this video with someone who still thinks volatility means something is broken, because understanding this could change how they see markets entirely. Use your own brain. Question everything. Don't follow anyone blindly. And remember, price is temporary. Access is everything.